Hi there, Salena Kulkarni here with another episode of the Alternative Investing Podcast. My mission is to help business owners build high-performance wealth that delivers reliable, predictable cash flow through unconventional strategies so they can fast-track their path to financial freedom. Each week I share with you the strategies, expert interviews, and real people's stories around the topic of wealth and financial freedom. And if you're a business owner who wants to learn more about financial freedom through alternative methods, please head over to my website, freedomwarrior.com.au, where you can access my library of articles, interviews, and programs to help you on your way to becoming more financially free. All right, guys, so I am really excited about today's podcast. I am finally unveiling a tool that I've been playing with for quite a while now, which is really designed to help people understand what is the trajectory if you kind of stay where you are and just use your surplus income or dividends to reduce debt on your property portfolio versus considering putting some of your precious capital into the world of alternative investments. I do think it's really difficult to wrap your head around the gravity that alternative investments can have on your property portfolio. So today's episode is really just trying to unpack at a granular level what I think people are looking to understand. So what I thought would be the most useful way for me to do this is to actually go through a case study. Now, obviously, I have changed the names, but this in fact is actually a real person or real couple, and their numbers are pretty real as well. So I just wanted to pre-frame this all by saying this is meant to be an illustration only, but you know, the purpose of any modeling, to be perfectly frank, is to give you a flavor of what's possible. I'm a huge fan of using spreadsheets and similar tools in a really basic way to help people understand that if they carry on doing what they're doing, what will that look like in the future? What will that look like in 3 years, 5 years, 10 years, 20 years? It's not necessarily meant to be something that you hang your hat on, but I think far too often people make investment decisions without kind of working out what will the impact be on their wealth over time. And I find that, you know, and I know this sounds like a typical accountant thing to say, but if you can get even a basic grasp on how different line items compound, even if it's like a 3-line spreadsheet, what that will help you do is stay on track. Because I think one of the big dangers of investing is obviously the shiny objects. So yeah, that's kind of like my pre-frame for today, which is that if you're not doing it already, learning the basic art of financial projections will save you so much heartache and, you know, I guess keep you on track and help you really optimize what you have. So let's get into our case study today. So after the financial shock of COVID-19, Tim and Rita are very vulnerable. They're feeling very vulnerable. They had a very successful event and catering business, and it is back up and running, but it's definitely limping. They're at an age and a stage of life, they want out of the business in the next 5 years, and they definitely feel their business value has been damaged, and they don't actually want to rely on the sale of this asset anymore. So the average household age for Tim and Rita are 52. They've got 3 kids, 22, 18, and 14. Now, you know, in their dream scenario, they're in COSI, as we call it in Freedom Warrior, or their dream income stream from passive income stream from investments is 200,000. Now I'm just going to asterisk all of this to say in COSI, which we use inside our program, is the Zulu word for tribal leader. It really is the guiding metric for our program. It's the great equalizer, because it doesn't matter whether your goal is 100,000 or 500,000. What we're tracking is progress towards that goal. So the reason I love this metric and the reason I believe it to be the great equalizer is that, you know, you're not necessarily trying to tell someone what your net worth is or how much you earn. The metric is about saying, well, how close to my goal am I? What percentage of that passive income have I earned? So, for those of you who want to get a copy of my tool, I'll give you the link at the end, but, it's all outlined in the tool itself. So going back to our case study, here's kind of why they want the $200,000. They want $50,000 a year to contribute to charities. They need $100,000 to live off, and they want to set aside $50,000 a year towards their family bank. Now, the family bank concept is phenomenal, very powerful idea around how to create wealth that lasts long after you're not around anymore. And we'll definitely have to unpack that in another episode. But these guys have been averaging income pre-COVID of about $330,000 per annum in their business. They already have a portfolio of investment properties. The assets, excluding the home, the property portfolio is worth 4.7 mil, and the debt on those assets is 3.3 mil. Now, they do have a home, but for all intents and purposes, they don't want to downsize, they don't want to move, and they're working towards paying that off, but there's very little debt left on that, and they don't intend to try to utilize any of the equity in that. Now, in terms of their borrowing capacity, they have a maximum additional borrowing capacity in the Australian market of about 1.5 mil, and their normal annual ability to save, which they're continuing to maintain even now that their business has reopened, is about $100,000 per annum. Really what they've said is they want to be diversified. So the options are, and this is how we play the game inside of our program, you've got to look across the suite of available strategies, but the goal of the game here is how do we safely get them as fast as we can to game over. Game over meaning they've got that passive income of $200,000 coming in, and they're free to make decisions about how they spend their time. So when I bring up my calculator, this is kind of like the starting point, really. I call it the Investment Diagnostic tool, and it's diagnostic from the viewpoint that it's giving you that insight, as I mentioned before, of where will you be and how will you fare if you kind of maintain the status quo and simply use your surplus income or dividends to pay down debt, versus putting a small percentage of your capital, your precious capital, into the world of alternative investments. Now, as we understand, in this case, when I plug in their gross assets and their debt, so 4.7 million in gross assets, total debt of 3.35, what I can see immediately is that they are earning about $18,000 net income, which is an average net ROI, return on investment, of 1.33%. Now, that is actually fairly typical for the Australian market. Of the hundreds of investors that I've looked at, and I've certainly looked at statistics online as well, the average net return for property which is held without any debt is about 1.33%. So they're probably going okay. The expected growth per annum, which I've assumed in this calculator on their local property portfolio, I've assumed to be 5%. I've assumed that the income they need, we talked about them needing, $200,000 in income, that will actually index at a CPI rate of 1.5%. Now, some of you may argue that CPI is higher than that, but let's just, index that at 1.5%. And, I've also assumed that, surplus cash is going to be applied to, in the first instance, debt reduction. So when we look at the graphical representation of what happens if they maintain their current portfolio and they take that $100,000 and apply it to the debt every year, what we can see over time is that there are two lines that show up on our graph. One is the required income going up over time, and the other line, the pink line, is the income that's actually coming off their portfolio. And what we can immediately see is that even though $100,000 a year is a significant amount of money, the impact that that has on the amount of income that it increases each year is minuscule. So in actual fact, if I give you, the first year, their $18,000 income jumps to $22,000, then to $27,000, $31,000. So, for $100,000 applied against that debt, the impact on the projected income is minimal. And so what we see if we kind of look at that over time is that the pink line definitely has a higher curvature in terms of trajectory than the blue line, which is just ticking along each year at CPI. But even when we get to year 24 in the future, those two lines, the required income line and the projected income line, they do not intersect, which clearly doesn't help these guys out whatsoever. The second part of this calculator is really about saying what percentage of your assets would you consider investing into alternative investments. Now, for those of you who are not familiar with alternative, I highly recommend you go back and listen to some of our past podcasts where we're talking about the 5 key buckets of strategies that sit squarely inside alternative. Now, typically in the deals that I do, I'm looking at a net return of somewhere between, and it's variable, but sort of 8 to 15%, and more typically 8 to 12%, I think is probably about right. And so for the purpose of calculating the impact on the outcomes for these guys, I've kind of said, let's assume that the average net yield on alternative that they earn is 10%, so net return of 10%. So in my second scenario here, what I'm going to assume is that the surplus dividends or income is $100,000 is going to be applied specifically to alternative investments. And then just for a baseline calculation, I'm also going to assume that they apply 20% of their portfolio to alternative from day one. So they refinance, or they pull equity, or they sell down an asset, whichever way you want to think of it, and they put that into alternative. Now, what I can see in this second graph is that if they focused on applying that 100K a year into alternative and took 20% of their portfolio, now just remember their net portfolio, the starting point is about $1.3 million. And they're going to take 20% of that and put that into alternative, earning 10%. What I can see immediately is that the two lines, the lines between what they need and the income stream coming from their alternative assets, intersects in sometime, I think it is in about year 8. So we're talking about two lines that don't intersect at all, potentially for 25 to 30 years, now intersecting in about 8 years. Now, the reason I've created this calculator is not to say you should, trash your portfolio and put it into all alternative, because that would be, definitely, that would fly in the face of my super conservative accounting brain that tells me that, you never want to go all in on something like alternative, no matter how lucrative. But given the risk profile of a lot of these investments, which in my mind are, they're very stable assets, they're very dull and boring investments, but they pay consistent, predictable, sustainable income. For me, the real game here is working out how much of my capital am I willing to allocate to alternative for the sole purpose of hitting my financial goals sooner. So I want to be just really clear that this particular scenario, and these guys are in their 50s, early 50s. Tim and Rita are very much in a situation where they want out. They want it to get to game over super fast. Whether they're able to sell their business or not is another question. But they just need to get to, really in actual fact, their actual baseline of income is 100,000. When they get to 100,000 in passive income, it's effectively game over for them because of the fact that they want 100,000 to live, and then they're looking for an extra 50 to put aside towards the family bank and 50,000 to charities. But in truth, if they got to 100,000, that would be, the start of game over. Everything over and above that would be cream. So when I look at my analysis here, let me change that to 100,000 instead of 200,000. And what I can see is that basically the timeline drops even further down to 4 or 5 years, which is, obviously considerable. So anyway, I guess the point that I'm making with all of this is it's not so much that I'm, suggesting that you commit holus bolus to putting a whole chunk of change into this alternative, but I genuinely feel that this is an asset class which cannot be ignored. I think if you're an investor who's sticking to the dogma of what worked yesterday will continue to work tomorrow, I think that that's a risky proposition. I think just because you've invested in something that's always done well doesn't necessarily mean that it will continue to do well. I think we're living in different times. I think economics are changing, and I think the smart investor is really trying to understand, how do I create true diversification? How do I bring more stability to my portfolio? What are all the levers that I can pull in order to optimize and maximize my cash flow and the strength of my portfolio? So guys, look, as I said, I will put the link to this calculator in my show notes. I definitely want to make sure that you understand that this calculator is really designed for people who are already on their property investing journey. It isn't really for newbies. If you're starting from zero, this might not be the right calculator for you. And look, it's not a perfect tool. It's really, as I said, it's a great visual. I have yet to find a tool out there that can incorporate the sorts of ideas that I'm trying to convey as this one. And as I said, it's taken me a pretty long time to even, finesse this one to the point that it's at. So guys, look, I hope you found this really useful. I think the big takeaway that I want to kind of leave you with is that, this concept of agility, of being nimble as an investor, requires you to have an open mind and to educate yourself on what else is possible. So I hope you found this useful, and look forward to catching up next time. Take care. Thanks so much for listening to the Alternative Investing Podcast. If you're a business owner feeling frustrated that despite doing everything right in the property investing playbook and you're no closer to financial freedom, then head over to freedomwarrior.com.au to learn more about how you can use alternative investments to catapult your investing income and blend strategies to shave decades off your timeline to financial freedom. Till next time, take care. See you on the next episode, and bye for now.